There is no magic in this, no secret pattern, no holy grail indicator. There is only this single, relentless truth: price moves to fill institutional orders. Everything else is decoration. Your indicators are measuring symptoms, not causes. Your patterns are tracing the footprints of the real players after they have already walked by. You are studying shadows. Think of the market as an auction. Now think of a massive asset manager, a true whale, who needs to buy 500 million of a stock for a pension fund. Do you think they call their broker and say, buy it all at market price right now? Of course not. They would annihilate the price, paying a fortune. So they work an order. They place a mountain of limit buy orders layered through a specific price range, a zone, where they believe they can accumulate their position without moving the market too much. They become a hidden source of demand. Price drifts down into their buy zone. Their orders start getting filled, absorbing all the sell orders from retail traders, other algorithms, and smaller institutions. But their appetite is huge. The buying pressure from their hidden stack of limit orders is so immense that it consumes all available supply. Suddenly, the selling dries up. The last sell order at that level is gone. The only orders left are more of their buy orders sitting there waiting. Price has to jump higher to find new sellers. This creates that fast, aggressive move away, the strong departure you see on the chart. It's not a bounce. It's the market hitting a brick wall of institutional demand and recoiling. But here is the critical part: they didn't get filled completely. Their 500 million order might only be half done. The other half of those buy orders, they are still sitting there, invisible to you in that zone, a resting order book, waiting. The market is memory here because money has an agenda here. That is your demand zone. Now you understand why retail concepts fail. Support is a line where price bounced before. Demand is a zone where a hidden imbalance of unfilled buy orders caused that bounce and is still lurking. The line tells you where. The concept of imbalance tells you why. Your job is not to predict. Your job is to observe and align. You go to the higher time frames, the 4-hour, the daily, where these institutional footprints are clear and not washed out by noise. You look for those swift, violent rejections from a clean price area. You mark that zone. And then you do the hardest thing in trading: you wait. You are a hunter waiting for price to return to the watering hole where the big game feeds. When price finally returns, you do not jump, you watch. Does price just barely kiss the zone and stall? Do the candles get small, showing the battle between supply and demand is happening right there? Does a strong bullish reversal pattern form within the zone? That is your confirmation. That is the signal that those hidden institutional orders are being filled again, creating the same imbalance. That is your entry. Not a pip sooner. And your stop loss, it's not below the line. It's beyond the zone. On the other side, where a break would clearly signal that the imbalance is gone, that the institutional orders have either been filled or pulled, and the market's memory has been erased. You give it space because the institutions themselves will often nudge price briefly through a level to trigger a cascade of panicked retail stops before reversing. They are collecting liquidity to fuel their own move. This is the shift. Stop looking for lines where price might bounce. Start looking for zones where price must move. Because of the unfinished business of big money, you are no longer a prisoner drawing bars on a chart. You are a tactician, reading the ledger of the real market, waiting to step in alongside the only force that truly moves price, the relentless, mechanical search for balance by those who move it. First, identify your demand zone on a higher time frame, 1 hour minimum, but 4-hour daily is better. Mark that zone clearly on your chart. This is your area of interest, not an entry signal. Do not watch the chart constantly or stare as price approaches. Only when price reaches your demand zone should you pay attention. Then observe how price behaves. Does it stop falling immediately? Are there strong rejection candles? Does it move away with momentum? This is your confirmation, indicating institutional orders are being filled. That is your signal to enter. Place your stop loss beyond the zone, not tight, not just under the low, but beyond it. Give the trade room. If the zone fails, you are stopped out. If it holds, you stay in the trade. If price enters your zone and consolidates with small candles, no strong move away, no clear rejection, do not enter. This shows price searching for equilibrium, meaning it might reverse or break through. In that case, wait or skip the trade. Another opportunity will always come. Your profit target is the next supply zone above. That's it by a demand sell at supply. Supply zones are identified the same way but inverted. Look for a sharp move up that suddenly reverses with strong downward candles and momentum. That area where price reversed is your supply zone, always a zone, never a line. When shorting at supply, your target is the next demand zone below. This process is mechanical, reflecting how institutions trade, buying low at demand and selling high at supply repeatedly. A common mistake is chasing price. You see price reach your demand zone, hesitate, then watch it move up fast. In panic, you buy far from the zone with a huge risk and a distant stop loss. Price often pulls back, hits your stop, then continues up. This is emotional trading that destroys accounts. Never chase. If you miss a trade, accept it and move on. Another critical error is re-entering after a loss out of frustration or ego without a new signal or confirmation. This is revenge trading. If your stop is hit, the trade is over. Analyze, learn, but do not re-enter emotionally. Entries must be mechanical, following rules every time without exception. This discipline separates professionals from gamblers. Yet the most crucial part of trading isn't entries or zones, it's risk management. Even the best levels fail sometimes. Institutions change their minds and unexpected events occur. Losses are normal and expected. The key is survival, which depends entirely on risk management. Professionals treat risk as a business expense, a necessary cost of doing business. Control your losses by never risking more than 1-2% of your account on a single trade. This allows you to withstand many consecutive losses without crippling your account. For the 10 no's an account and 1% risk, if your entry is a 50 and stop loss 48, you buy 50 shares. A stop loss costs 100, barely affecting your account or psychology. A win to 55 profits 50, even with a 40% win rate and a 21 reward to risk ratio, you remain profitable over time. Position sizing matters more than win rate, ignoring it by risking 5% or more on a perfect trade leads to emotional damage and blown accounts when losses compound. Remember, risk management is everything. Let's talk about what really happens when you ignore position size. You buy 250 shares because you're sure the setup is perfect. The price drops, triggers your stop. Your $10 an account is now $9,500, a 5% loss in one trade. You take another similar trade and the same thing happens. Another 500 gone. You're now at 9,000. Just 2 trades and you're down 10%. Now you need an 11% gain just to recover to break even. Psychologically, you're shaken. You start doubting your strategy, your rules, even yourself. Fear sets in. You either freeze and miss good setups or you become reckless. You chase trades, break your rules, increase risk to make it back fast, and before you know it, you blow up. I've watched this pattern ruin talented traders again and again. Their analysis was solid. Their understanding of the markets was real, but without strict risk management, they failed. Now, consider scaling out. You enter long at a demand zone. Price moves up to the first supply zone, your initial target. You could exit fully and take the profit, or you scale out, take 50% off at that first supply. Move your stop to break even on the remainder and let the rest ride to the next supply zone. This does 2 critical things. First, you lock in profit. Even if the trade reverses, you've made money. Second, you give yourself a chance at a larger win. Professional traders scale out. They don't hold full positions hoping for a perfect exit. They take profits along the way, protect their capital, and never risk giving back all their gains. Moving your stop to break, even after taking partial profit, is non-negotiable. Never let a winning trade turn into a loser. The worst outcome then is break even. You've protected capital, locked in some profit, and stayed in the game for more. Understand this clearly. Consistency beats excitement every time. New traders dream of doubling accounts monthly. They want the huge wins, the rush, the ego boost. Professionals aim for steady, repeatable returns, 2%, 5%, maybe 10% per month. It sounds boring, but compounded, it's life-changing. Just 10% per month doubles your account every 7 months. In 5 years, 10,000 grows to over $3 million. That comes from boring, disciplined, mechanical trading, not home runs. Risk management is what makes this possible. It keeps you in the game long enough to let compounding work. Institutions survive because they manage risk first and pursue profit second. You must do the same. What truly separates professionals isn't intelligence, secret indicators, or insider knowledge. It's mindset. Professional trading is about rules, not opinions. You don't trade what you think might happen. You trade what the market shows you. You don't predict, you identify imbalances, demand zones, supply zones. Then you wait for price to reach those zones, wait for confirmation. Then execute, mechanically every time. No opinions, no hoping, just rules. This is boring, and boring is good. Exciting trading is usually losing trading. If you're feeling excited, you're probably about to make a mistake. If you're calm, even bored, you're likely trading correctly. Patience is your greatest edge. Most traders can't sit and wait. They need action, they need to feel busy. That's entertainment, not trading. Here's what real patience looks like. On Monday, you review charts and mark 2 clean demand zones. Price is 200, 300 pips away. You set alerts and close your platform. You go live your life, work, family, exercise. Tuesday, you check in the morning. No alerts, no setup. You do nothing. Wednesday, Thursday, the same. Friday afternoon, an alert sounds. Price approaches your zone. You watch for confirmation, strong, rejection, momentum shifting. You enter, set your stop and target and walk away. You don't watch tick by tick. You set alerts and go enjoy your weekend. 5 days of waiting for one high probability setup. Most traders would have taken a dozen low-quality trades out of impatience or FOMO. You waited for one clear edge. That's the difference. Professionals take very few trades. They wait for the perfect setups. If you're taking 50 trades a month, you're over-trading. Even 10 may be too many. 3 to 5 high-quality trades per month is professional thinking. Each is planned, meets all rules, and has strict risk management. No random entries, no impulses. Just patience and execution. You will have losing trades, many of them. Even with flawless analysis, 40% of your trades might lose. That's normal. The key is how you respond. Do you get emotional, angry, seek revenge? Or do you accept the loss as a business expense, review it calmly, and move on? Professionals don't care about any single trade. They care about the next 100 trades. They know their edge plays out over time. 5 or even 10 losses in a row is possible, but with solid risk management, you survive. And over the long run, you win. For those with small accounts, 500 or ones or nows, your primary goal is not to make money. Repeat that, your goal is not to make money. Your goal is survival. Your goal is learning. Your goal is proving you can follow your rules. If you can grow a small account by 20 or 30% consistently over 6 months, you've proven discipline, patience, and risk management, then you can add capital. But if you try to double it every month, you'll take huge risks, overtrade, and blow up. The cycle will repeat. Stop trying to get rich quick. Start trading correctly. The money will follow, but only after you prove you can survive. Avoid burnout. Don't spend 10 hours a day staring at charts. That leads to fatigue and poor decisions. Professionals review charts, mark zones, set alerts, and walk away. They live their lives. When an alert triggers, they evaluate and act if the setup is valid. Then they walk away again. This is sustainable. This is how you trade for decades. Finally, remember these principles: don't predict, identify. Don't trade often, trade well. Don't chase price, let it come to you. Never risk money you can't afford to lose. Don't compare yourself to others, compare yourself to your own rules. Don't seek shortcuts, there are none. Don't blame the market, take responsibility. Don't celebrate wins too hard, you're just following your plan. Trade for consistency, not excitement. The market rewards discipline, not intelligence, not luck. Discipline to wait. Discipline to follow rules. Discipline to manage risk. Discipline to accept losses. Discipline to stay patient when nothing is happening. That's what makes a professional. Not perfect entries, not secret levels, discipline. Remember, the market moves on supply and demand imbalances. Institutions create these. Trade with them, not against them. Wait for your levels and enter with confirmation. Manage on every trade. Accept losses. Focus on process, not outcomes. Stay patient. Now go review your charts. Mark your zones. And wait. Be patient. The market will come to you.